With Green Retirement, and it's always good to see everyone. As I noted to Nick, I have a disclosure to give, so here we go. I'm Timothy Yee, a registered principal offering security advisory services through Independent Financial Group LLC, IFG, a registered broker-dealer and investment advisor, member FINRA, SIPC, OneAmerica, Green Retirement, and IFG are unaffiliated entities. Having said that, and with that out of the way, Nick, it's good to have you in from One America to talk about long-term care. And folks, this topic is personal. Those of you who know Rose, my lovely wife, mother-in-law has dementia. That's about as politely as I can put it. And we really struggled with in-home care during COVID, taking care of her. It was a handful. Anyone who's gone through dementia with a parent or a loved one knows it's challenging. There was one meeting that I was getting ready for on Zoom. I had my notes all properly laid out, and mother-in-law went off in a completely crazy direction, which we had to tackle. And then I was expected to be ready in 15 minutes on Zoom with my tie in place, looking proper and professional, whereas 13 minutes earlier I had been running around with gloves, disinfectants, and mops. And she's one of the lucky ones. We have managed to get her home to the Philippines, where her Social Security is enough to provide her 24-hour care. But here in the United States, that is not the case. And as Nick, a veteran of the long-term care and insurance industry, is going to lay out, we have some challenges here. So, Nick, I really appreciate you showing up on this topic, and it's timely. It is something we have to think about, not just for parents or relatives, but I feel 35, but the reality is I'm 57 with some gray hair starting to appear. So why don't you take it? And folks, as you have questions, please pop them in the chat. This will be recorded. It will be going on to YouTube. I have now learned, and from there it can go to my website. But Nick, welcome. Give us your background. Tell us about
Perfect.
long-term care.
Thank you so much, Timothy. I'm going to get my screen shared while I'm introducing myself. But my name's Nick McCormack. I'm a regional sales director for OneAmerica Financial. I've been in the insurance space now for coming up to 15 years. But what really transitioned my career into long-term care specifically was kind of like Timothy. I had a personal event with my grandma who needed care. And thankfully, she had done a lot of planning around long-term care and the possibilities of what could happen with her and my grandpa. So it wasn't as traumatic as it could have shaken out to be, but it was enough for me to see the handwriting on the wall for millions of families across the country who aren't prepared like my grandma was. So there's a lot of room there for folks to improve their situation on long-term care planning, and that kind of drove my passion into this sector of the industry. So today we're going to cover, am I still sharing the right screen here? Because it's not highlighting me. Let
No,
me,
it looks good on my side. I'm
okay, looks
seeing the
good.
agenda, Nick, saying what is
Excellent.
long-term care?
I lost my green border here. So what we're going to talk about is what is long-term care, because a lot of folks have the wrong idea about what long-term care even is. They don't even understand the problem. We're going to go over some facts and figures, some statistics, some a little scary, some might be kind of what you were expecting, but we'll go through that. We'll talk about the impact that long-term care events have on families, relationship-wise, the emotional impact, as well as the financial impact. And if we have time at the end, we'll get into some hypothetical examples too. So, jumping right in here, what is long-term care? Now, most folks, when you talk about long-term care, when you think about long-term care, you're thinking about the worst case scenario, end of the line, hospice care. We do not have much time left, something severe. And the reality of long-term care is that it covers a wide range of services before we get to that point. It's really about preserving our way of life, our day-to-day activities, and just getting by. And so, when folks think about someone in their life, sometime in their own lives, when they've known someone to be impacted by long-term care events, a lot of times they draw blanks on that. They go, Nick, I really can't think of anyone that I know that has needed long-term care. And a lot of that's around the fact that we think about long-term care being end of the line. The reality is, I'd like you to think about, have you ever known someone who started to need a little bit more help as they got older. Simply put, they needed some kind of help. The neighbor that needed you to stop by once in a while to check on them, someone who needed help with meals once in a while, someone who just needed a little help cleaning. Those are the kinds of things where when your doctor notices that you need help with those things, they would likely recommend that you get outside services to help you before you become a danger to yourself and get hurt and then need some really serious help. So, of course, long-term care covers the severe things, the severe cognitive, the Parkinson's, the truly awful diseases, but it also covers a lot before you get to that point. Um, so just understand that, even though long-term care may not seem like it's on the forefront in your life, there's surely some folks that you've known who have needed help in that arena. Now, the cost, unfortunately, is tremendous. For folks that do need to pay for long-term care services, it can make a dramatic impact on where they saw their retirement going. Because if suddenly you start needing to lay out an extra $70,000 a year to pay for home care for your spouse, that's something that's not in a lot of folks' retirement plan already. The informal care, that's unpaid care. So when we ascribe a dollar value to that, we're talking about lost wages for folks who had to provide care for family members when they didn't have other means to pay for it. Assisted living, of course, we know what that is, and nursing home care, which again is what most people think is the majority of long-term care, but it's really so much more than that.
That's a good point. And folks, I'd point out at least what I've seen, and I think you're alluding to it, Nick, here, is that the average stay in a long-term care in a nursing facility generally is 3 years. If
Hmm.
it's home care, it's 5 years. So you can take those figures that Nick just showed you, multiplying by 3 or 5 as appropriate. And I think the idea is home care, you are more in comfortable surroundings, you know where you are. And certainly in the case of my mother-in-law, she is getting massive one-on-one attention. She's surrounded always by somebody 24 hours a day. In a nursing home, that's not necessarily possible. Back to you, Nick.
Thanks, Timothy. Yeah, so touching on that, I think one thing worth mentioning is that most folks do imagine that the care that they would want to receive is in their own home. And I would tend to agree with you in most cases, but I lived the experience with my own grandma, who was always, I'll call her Nanny because that's what we called her. Nanny always believed that she would want to stay at home. She never wanted to be in a facility, as they call it, until my grandpa passed away, and Nanny's vision started to go shortly after that. So Nanny went from being a social butterfly with her husband in the home and president of the women's club to no longer being able to even leave her own home, and her only interaction was when we would come to visit her every week. So that was someone who passionately believed that they would only want home care, but then could not wait to get into assisted living and have a community again of folks that she was friends with. So around the lengths of stays, the average stays, we have two forces pulling on that. We have the folks who need severe care, they need care right away. Some serious medical condition happened and they don't even last a year. Okay. Some folks don't even last a year in long-term care. If we remove those folks from these statistics, if we only look at the folks who need it for a year or longer, we add 2 years to these averages. Men need nearly 4 years of care. Women need over 5 years of care on average at that point. And as I think Timothy was alluding to, these are just averages. A lot of people are going to need longer. A lot of people are going to need less. And for those that do end up with an Alzheimer's diagnosis, the average there is 8 years. And now here's the other side of the coin where folks are pulling those averages longer. These are some of the longest claims in asset-based long-term care insurance history. A lot of these, I don't know how many of them are still active, but we have a few of these that are still on the books at OneAmerica at least. And so, this is the reality that is really tough to plan for. Someone who's going to need 14 years of care, what do you do about that? OneAmerica comes in with a solution there. I don't want to put my sales hat on. Unlimited benefits would be the only way around that, but we can get into that later. Why are people making claims,
Yeah,
right?
I think the
Initially,
point I would say, Nick, is
yeah.
exactly what you hit on. If the average cost is 70,000 in 14 years, you have a claim going. I don't know any financial planner who can A, predict that and B, generate returns to try to pay for that. It's unless you're fabulously wealthy, I don't really see how that works. I'm just seeing a gap and a mismatch. Am I right?
Yeah, that's absolutely correct. The only people that can afford to do that are the fabulously wealthy, in excess of $10 million net worth. They don't need to break a sweat about this necessarily. But for the rest of us mere mortals, this is a little concerning. Now, why are people getting into claim? What triggers a claim? Most of the time, it's a cognitive issue, right? We have things completely outside of our control, mental, nervous, either, our minds or forgetfulness is coming in, we're shaking, we're unable to function, we need help. Outside of that, almost 30% of the time we have physical issues. Only 12% of the time is illness related, which honestly surprised me a bit when I saw these stats for the first time. Um, yeah, it's interesting. What are the ages that people are starting on claim? The youngest is 38 years old. I'm 38 years old. Average 84, oldest 103. Most of our claimants, women. The guys just die, I guess. They don't hang on. Facts and figures. Now, here's some unsettling realities that we're seeing across the marketplace that are kind of troubling everyone in the insurance industry, at least. Number of people needing care is only going up. We're in the middle of what's called the silver tsunami right now, where we're seeing more and more people turn 65 and retire than we've ever seen since we've been keeping track of those stats. So we're seeing, 10, 15 years from now, when those retirees start to need long-term care help, the demand for care providers is going to be huge. And so the impact that that potentially has on the price of care is frightening and a little bit unpredictable. At the same time, people are just living longer. So, they're living longer, but we don't really talk about how they're living, and how they tend to be living longer is needing help, with activities of daily living. So as folks live longer, they're going to need, that home care, that assisted living for longer puts even more pressure on the demand. Family dynamics, who's providing the care now? Do folks want to have their children provide the care for them? Do they want it to be a spouse? I heard that all the time when I was out in the field. Um, and lastly, what government programs are going to be available? Because can we count on what's available today to be available 20 years from now, or even next year in some cases? What do we want to lean on that to to assure that we're going to have a happy retirement situation? Now, the next fact I'll lay on you is that 70% of adults aged 65 years or older are going to require long-term care at some point. And so if you're married, if you have a spouse and you both have a 70% chance of something happening, that means between the two of you, there's over a 90% chance that at least one of you is going to need help. Is it accurate? Yes. I don't know why that's on my slide, but I can't modify it. So, yes, it's accurate. We have a citation there to prove it. You can go there and see it for yourself, and they get into the legwork that they use to determine that. But point being, there's a 90% chance that in a couple, one of you is going to need long-term care. And so it's worth having a conversation around.
And folks, I will put in the chat box, if you remember last October on our first Friday 401k, we had a session from some scientists and they talked about retaining your brain. Nick, that really hit where you said 55% of people go into long-term care because of cognitive issues. So in the chat, you can see a little bit of a workbook publication on retain your brain and how to keep your brain active. Obviously, things like physical, that's important. The one that you cited at the end, Nick, the 12% illness. Yeah, well, don't smoke, don't drink excessively, what have you. There are some things you can do, but the cognitive part, really a fascinating study and bit of work that the Hartford group did, and we talked with the expert last October. Back to you.
Thanks, Timothy. Yeah, the cognitive thing is really scary to me because I feel like there's so much other, like you alluded to, preparation I could do. I can not smoke, I can exercise, I can stay in the best shape ever. But how do I fight off the cognitive perils? That's frightening, and that's what's impacting most people. So
Well, my suggestions, folks, geocaching, and from Rose, who is currently in the Philippines with mother-in-law, knitting. If you know Rose, you see her in Zoom meetings and the knitting needles are going. She's keeping her mind mentally active while also coming up with some really amazing sweaters. And for me, my outdoor scavenger hunt geocaching keeps my brain active.
I love that. So we ask people, you may not need care, but if you do, how will it impact your family? And for most families that I've sat in front of and I've asked, what are you going to do in the situation where you need help? You need long-term care. And they'll tell me, well, Nick, got my spouse right here. They're going to take care of me. And, I would sit in these meetings and I would say, well, if that's a plan and you guys are both comfortable with it, fantastic. I'm glad that we talked about this. This is going to be great. What I've come to realize is that we don't really know what we're going to look like 20, 25 years from now. And even if your wife can hoist you out of bed right now and onto the toilet, I don't know if she can do it 25 years from now when she's 85, 90, 75. You know, there's a lot of physical challenges to taking care of someone, not to mention the emotional impact. They, especially for anyone who's ever dealt with someone who has a cognitive issue, the real toll are on the caregivers in that situation. They are the ones who are living this reality and actively providing the labor to provide life for the unhealthy, cognitively impaired person. The person that's dealing with the cognitive impairment may not even understand what's going on or may forget about what happened yesterday to really appreciate all the effort that's being given. So the emotional impact is tremendous and something a lot of folks don't realize until they've experienced it. The other thing I'd hear a lot is they would say, Nick, my daughter's a nurse. She's going to take care of me. To which again, my inexperienced self at the time would say, that's fantastic. I'm so glad you have health care in the family. She's going to do a great job, I'm sure. What I've come to find is that, most daughter nurses, they have an existing career already, maybe at a hospital, maybe a few states away from where you're living. And so the advice I'd give is that if the plan is that a family member, a spouse, a nurse daughter, nurse son, my brother's a nurse, if a family member is going to provide your care, make sure you have that conversation with that family member and make sure they're aware of the fact that they're signed up for that and that they've considered the kind of implications that that would have on their life because the nurse daughter is probably bringing up some of her own kids. So even if she is nearby, the in most cases, I think we find that we'd rather have the expert in the family and healthcare overseeing the paid care to make sure it's being delivered in the best way possible versus providing that care themselves. Of course, I never actually saw this in the field, but I guess some people, their adult siblings are going to provide the care or their friends. Maybe you make a pact with your friends that, whoever stays healthy takes care of the rest of you guys. Yeah, that could be a plan too.
Yeah, and
Uh,
I would stress the emotional impacts, folks. Again, I'm only speaking for myself. I can't obviously speak for Rose, but when mother-in-law was living with us, I found myself constantly in a heightened state of vigilance and awareness. We were getting ready to go to a 401k conference in Florida, and I noticed that somebody had spilled marinara sauce all over the back area leading out to one of the outside doors. And like, guys, come on, marinara sauce. If you spill it, clean it up. Turned out it wasn't marinara sauce, it was actually blood. And mother-in-law was safely in bed, and I'm like, okay, what's going on? She had tried to get out, slipped, fell, hit her head, and managed to get herself back to bed and go back to sleep.
oh my gosh.
And now I'm meant to go off to the airport and off to a conference, and here I'm trying to coordinate mother-in-law, and it just constantly having to be aware of where is mother-in-law? Is she upright? Does she have what she needs? You can't run an entire house, a career, and that. It's challenging, folks. Again, just my view. Rose probably would have said, "Don't worry, Timothy, I've got it under control," and she always does.
Thanks, Timothy. Yeah, it is absolutely challenging. And what we see a lot of times, I'll add, when we do have children that are trying to provide care for their parents, is that the children end up kind of at odds with each other because nobody ever feels like they're doing a fair amount of work or that everybody else is doing a fair amount of work. Even when it is evenly divided, as best you can, tensions do tend to build. And so that's kind of the other end of that where, if you're starting to need help as you get older, do you want some of the last times potentially with your family? This is very morbid, but do you want your family to be arguing around providing the care? And so, it all comes down to just putting a plan in place. it's not necessarily insurance, and for a lot of folks, insurance doesn't make sense, but it's about having a plan. And so that's where it kind of comes in where if care is needed, how will you pay for it? In lieu of family members providing it who may be there as a last resort, but what potential do we have to take that burden off of them? And the number one way, and this is kind of the default, which we're all subscribed to in lieu of any other planning, and that's taxpayer assistance. That's where we just pay out of pocket for the care that we need until we run out of money, and then Medicaid picks up from there. And it's, I would say, the least ideal scenario because you don't want to be in the position where Medicaid is picking who provides your care or limiting the pool of providers that you have to choose from. As someone who's seen both sides of the coin, I would certainly urge you to visit the types of facilities that Medicaid will provide for you. Um, the second avenue, and this is what was most popular for decades at this point, traditional long-term care insurance. The problem with traditional long-term care insurance is that it kind of put a bit of a mark on the industry, a dark mark where folks bought this coverage, 15, 20 years ago. They experienced no premium increases for most of that time. And then as they got older and it started to come to the point where they were going to need to use the coverage, all of a sudden they were getting letters from the carrier that their premiums were going to go up or they were going to severely lose their benefits. They were going to cut it in half, lose all their inflation, etc. And so there's all these horror stories across the country of folks who paid for this insurance for years and years and years. And then right before they were going to use it, the insurance company kind of pulled the rug out from under them. That's a big hurdle for us to get over in the industry in general. That was a horrible thing to happen. Um, the policies were sold in the sense where, they could go up, but they never have. And so a lot of folks felt secure in that. But once they did go up, it kind of blew up the whole industry. Needless to say, we have another solution now, which I'll get into in a moment. The last traditional way to do it was to pay out of pocket. And that's a legitimately good option for a lot of folks because putting insurance in place doesn't make sense for everybody. Put insurance only makes sense kind of in the middle of the field. If you're on the lower end of assets or you're on the extreme higher end, insurance stops making sense to purchase and it makes more sense just to put a plan for care in place. In insurance isn't the only way to solve the long-term care problem. It's one potential solution to the funding, but more important than insurance is just having a comprehensive plan in place ahead of time that says, hey, if we do need help, where can we get, what assets are we going to spend down first? And how can we position our assets to potentially make that last longer, make our retirement last as long as possible in the event of a long-term care situation? So
Yeah, and I
an impact
really
on
would be
finances.
concerned, Nick, about that last option. You want, certainly from mother-in-law, we wanted quality of care
Hmm.
and we wanted to have the financial resources. And when father-in-law had heart issues in 2012, yeah, he was on Medicaid. And, the group home did the best they could, let's say that, but it wasn't, I don't think they really were doing right by him, and it was challenging. And so looking at self-pay may not be an option, particularly with those average numbers you showed, 77,000. That's a significant chunk of money.
It certainly is. And I hate to be in a position ever where the money's dwindling down and we're hoping that we can resolve this situation before the quality of life starts to decline.
Yeah.
It can be so tough. And I know my nanny in assisted living, she was paying in excess of 10 grand a month in her final
Ooh,
days
ooh,
there.
ooh.
That was 5+ years ago. So yeah, and that was in northern New Jersey outside of New York City, so the cost of living there is excessive, and
Hmm.
that
Hmm.
lends to that a bit. But regardless, people don't realize what a big impact it's going to have, and it's really an income issue more than having a lump sum there because people are usually retiring to some kind of income. And if we start pulling, $60,000 extra out of that income, what's left for the surviving spouse to live on? Often not much. Um, when we do use assets, we do tend to get through them quicker. Has a ripple effect on all the other planning we've done.
Hmm.
And so the bottom line is it's just something that's totally worth addressing, one way or the other. Get some kind of plan in place. It's an income problem, not an asset problem. Now, the government, the United States government, kind of saw the handwriting on the walls with Medicaid, right?
Hmm.
Because once folks run out of money to pay for their own long-term care expenses, they get onto Medicaid, and that's the federal government paying now for their care in whatever small way they do. So back in 96, they started passing legislation to try to incentivize insurance companies and individuals to prepare for this themselves. And the first thing that helped us was this HIPAA law of 96 allowed us to use life insurance policies in a way for long-term care. We're allowed to spend the death benefit down before we've died to pay for long-term care expenses. And that created a whole industry, which is where my company, my carrier sits, OneAmerica Financial, of asset-based long-term care, where we're able to build these long-term care policies that don't just have, we hope that the price stays the same. We're able to guarantee that the price stays the same. I'll get into that more momentarily. But the other piece of legislation that helped us was the Pension Protection Act of 2006, which also gave us a little bit of leeway to use annuities, existing annuities
Hmm.
that have gains in an advantageous way for long-term care. So, as I mentioned, this legislation allowed for the creation of asset-based long-term care, which is where OneAmerica Financial sits with their suite of products here. And the idea behind asset-based long-term care is that we carve off a portion of your conservative portfolio and we allocate it for long-term care expenses. So right off the bat, you could see how this isn't for everybody because not everybody has a portion of their conservative portfolio that they can allocate towards long-term care. Some folks
Hmm.
need 100% of their retirement portfolio to possibly even retire. So that being the case,
Hmm.
if that's you, asset-based long-term care isn't probably the best fit, but you should still be doing some kind of planning. Make a plan for care to still figure out how to best manage your situation. So for asset-based long-term care, we carve out a portion of their conservative portfolio. We create leverage, oftentimes with a death benefit or with an annuity. And by creating that leverage, we're able to protect the rest of the portfolio from potential long-term care expenses. And one of the things that OneAmerica does differently than any other asset-based carrier is we offer lifetime coverage, which is not limited to a 4-year benefit, a 6-year benefit, 8-year. It's OneAmerica will pay for as long as you have a long-term care claim, including up to those 18-year claims that I referenced earlier. But the real value to a lifetime benefit to me is that it's a permission slip to just use your policy. Because if I only have 4 years of coverage, I may be a little uncertain if now is the time to pull the trigger on starting my care when my care needs are on the easier side. While I just need help with my medicine and a little bit of food. I'd rather have my family help me with that and maybe save that money for the back end when I need help toileting and showering. Maybe I'd rather have my family members not doing that. So the point is, having an unlimited policy is just a permission slip to use your coverage as soon as possible. You don't have to think about whether now's the right time, because it's always the right time to get into the insurance company's pocket if you can make a claim. So we say, live, quit, or die. You're going to get your value back from an asset-based policy. There's either the cash value for you to surrender into, the death benefit goes to your heirs if you die having not used the policy, or if you do need it for its intended purpose for long-term care income, it's there to pay that for potentially an unlimited duration. Now, how asset-based long-term care works is, as I mentioned, there's a life insurance policy or an annuity. Okay. And then we add a second component to that, which I'm sure this is going to. Yeah. So on a long-term care claim, the first thing that happens in an asset-based policy is you get kind of your own money sent back to you, right? You're going to spend down your life insurance death benefit or your annuity value first in a claim situation. Once you've gotten through that money, OneAmerica continues to pay a long-term care benefit with our rider. We call it a continuation of benefits rider, and that's what potentially extends the benefits to be unlimited. Doesn't have to be unlimited. We do different buckets as well, but more than half of what we sell has the unlimited rider on it. So let's talk about a couple hypothetical examples here. This should drive home how these policies work. So, for example, this is a couple who's 60 years old, male, female, both 60. They have $150,000 of cash or cash equivalents that they've determined with their financial advisor they're not going to need to live off of in retirement. They have enough income from other assets that they can allocate $150,000 in cash towards solving the long-term care issue. So with OneAmerica, that shakes out to be $7,600 a month long-term care benefit each with a $182,000 death benefit. So that means if something happened the day after they bought this policy or 20 years from now, where our hypothetical couple got hit by the Mack truck and they both passed away having never used this policy, $182,000 is coming back to their heirs. If they do need the policy, they both have access of up to $7,600 a month per person. So if they're both on claim, we're paying, over 15 grand. This this is something that can insulate you from those huge expenses of 70 grand a year today, which is only going to be more in the future. But again, to drive home how this can't make sense for everybody because you have to have $150,000 in excess of your retirement in cash for this to be a good idea. So we have some ways to work around that for other folks. We have, in this scenario, we're showing an $80,000 lump sum with an ongoing annual premium of 54.59 to create that 7,600 and $182,000 death benefit. So very similar coverage, just a different way to pay for it. But again, with savings that are cash.
Yeah, to that question, Nick, a person who couldn't attend this webinar was asking if it's possible to take, say, monthly benefits from Social Security and just have that, redirected as a premium payment. I know typically we're talking about lump sums. The slide before it was
Mhm.
150,000. And not everyone has 150,000, but somebody could maybe month by month possibly do that. Is that a possible solution?
Absolutely. And on my example here, it shows that as an annual premium, but these can be paid for monthly as well.
Uh-huh.
So here we're showing for this is a younger couple because it's usually younger folks who are going to pay for it annually. We
Mm.
have a 49 and a 48-year-old paying $5,600 annually, and that's for both of them. That's not each. They together pay $5,600, and they have a $7,000 a month long-term care benefit with a $168,000 death benefit.
Now, are you saying 5,600 for how many years?
This is unlimited.
Okay, so it's 5,600 until they go on claim. Is
No,
that
no, no. I'm
or
sorry.
what?
I'm sorry. I was
Sorry,
talking about
I'm
the monthly
this is not
benefit.
my area of expertise,
Yeah,
so I'm
yeah.
asking
And
silly questions,
I
but
misunderstood your question. It's
yeah.
5,600 pay to 95. So it's when the
Yeah.
male at 49 reaches 95, the premiums stop, or or if any of them get on claim. Once
Okay.
somebody gets on claim, the premiums are waived for as long as that claim lasts.
Yeah. So this reminds me very much, folks, of fire insurance. Again, I know I bring up mother-in-law a lot, but she is very near and dear to my heart. As a homeowner, I've paid for fire insurance year in, year out, and never had a claim until, well, unfortunately, mother-in-law burned down the garage in 2017.
Hmm.
I was very happy to see the insurance agent running up the driveway waving a checkbook and saying, "What's going on?" I'm like, "You're never going to believe this." But yeah, that was the end of our garage. We now have a new garage. But yeah, all the years I paid premiums. I never filed a claim. So respectfully, Nick, the insurance company, quote, won. But when I filed a claim, oh boy, was it a whopper. I never knew how much it cost to reconstruct a garage. And I'm glad the insurance company backed me up on that.
Yeah, absolutely. If you when you need it, you're very thankful that it's there. So laying out all this premium at once is a lot for most families. So one thing that folks will try to do is kind of stack
I
these
love that
policies over
thing.
time. As they can afford to pay more, and assuming that their health remains insurable and good, we can continue to kind of add to the coverage over time as we get older. So the bottom line there is not to let perfection be the enemy of progress. Sometimes we need to take incremental steps in the right direction in order to put a comprehensive plan together. So, over the four buys over what are we over 15 years here, we've accumulated uh, almost $100,000 in long-term care income for a $7,000 annual premium. So just something to keep in mind. Now, sheesh, there's a lot on this page. We can
We
also
might
use,
skip that one.
yeah, don't, I mean, I wish I could stop people from reading it, or maybe I should just give you a moment to read it. But the bottom line is that we can also deploy qualified assets in order to solve this long-term care problem. And for a lot of folks, this is a great avenue because they have been saving the lion's share of their retirement assets in a 401k account or an IRA.
Mhm.
And so OneAmerica has a turnkey solution to deploy that money and turn it into a long-term care plan. But kind of the same guidelines apply where, it needs to be money outside of what you need for retirement.
Yeah.
If we're looking at your last $300,000 in your IRA account, we wouldn't take $100,000 of that to use in a long-term care plan because the last 200,000 is probably not going to be enough to live on. We never want to have to come back and take that money out of the long-term care allocation. But for those who have it, the excess qualified funds, this is a fantastic solution. And the other place that this fits that some folks don't think about are, and this is a mouthful, but I'll explain it, non-spousal inherited IRAs. And that's when
Oh, the 10-year.
somebody other than a spouse
Mm-hmm.
has died and made you the beneficiary of their IRA. Most commonly, it's parents. The parents pass away, they leave the IRA to their children. Those
Mm-hmm.
children, those adult children, have to spend that money down in 10 years since the 2019 Secure Act. The IRS requires it.
Mm-hmm.
The 10-year spend down fits perfectly into OneAmerica's turnkey solution for handling these qualified dollars. So for anyone who has inherited an IRA in the last year, this is a great way to go as well. It's certainly good for anyone who has excess RMD, someone who doesn't know what to do with these distributions the IRS is forcing them to make. We can reallocate them into long-term care and put some kind of purpose into them.
Mm-hmm.
Certainly, anyone who's looking at a Roth conversion, this is another way to burn into cash. Um, Anyone concerned about future needs for extended care, of course. So here's how it works. We take, in this example, $150,000. We add a 25% premium bonus to that. So for 150 with the 25% premium bonus, we get 187,500 total.
Mm-hmm.
That amount is distributed over 10 years into our 10-pay asset care plan. So 187,500, we distribute a tenth of that every year. That means you're being taxed on 18,750 of additional income every year for 10 years, while the money transfers from a taxable account into a tax-free long-term care policy. So, first question most folks have around that is, why do I want to be taxed on these distributions, Nick? You're just adding a tax bill into my situation. Why would I want to pay that? The reason that you want to pay for your long-term care policy with after-tax dollars is because that makes your long-term care policy tax-free. If we could cram pre-tax dollars into it, which OneAmerica won't allow you for this product anyway, but if we did, your long-term care benefit would now be taxable. So
Yeah.
we're taking the controlled taxable distribution of 18,750 that you can plan around, and we're taking that instead of the out of control fire sale of spending down, liquidating your qualified assets and having a ton of income all at once, because that could create a stickier situation for most folks. So we distributed 18,750 over 10 years, and you have a paid up policy. So in this example, our 60-year-old couple's back. This time they have $150,000 of qualified assets instead of cash. And what we get is a little bit less than if we used $150,000 cash. So that's to say we'd only use retirement money if that's where the lion's share of your money sits. If you have plenty of cash, we'd use cash because you'd get a better benefit that way.
Mm-hmm.
But for our $150,000 qualified transfer, we get nearly $7,000 a month in long-term care each, 6934, and a death benefit of 166,415. So we like to see that where the death benefit covers the premiums we've paid. So even if we don't end up using this policy, we at least get our money back into our family here.
Mm,
Um, Conceptually, I like to describe the difference between traditional long-term care, what was in the industry for years and years and has a kind of a black mark on it now, to asset-based, what we're talking about here. I like to compare that to renting and owning your home.
mm,
Traditional long-term care is like renting, where it's the least expensive way you can possibly get the insurance or the place to live, if you will, but it doesn't have guarantees and it doesn't have equity. So the rent can go up, and if you don't end up if you don't end up using it, there is no value there to go to your family. You just paid all that rent for all those years and poof, it's gone.
mm,
Asset-based long-term care is like owning a house where you have guarantees. The premium's guaranteed not to go up. Just like I guess your mortgage could go up if your fees go up in your insurance, but it's guaranteed in this situation. So the premium's guaranteed and you have equity. So if you decide you didn't need that coverage anymore, you can surrender it and get money back. Or if you never ended up using it, money goes back to your family. So just like renting or owning a home, and I'm going to come back to this again, uh, different, owning a home is not for every family. Renting a home's not for every family. Everybody's situation's different. You got to look at it. And so coming way back, again, we had nearly $7,000 for a $150,000 contribution here. We have the cash value, the death benefit, and the income. So point being, if you have the asset to use, this can make a ton of sense because we're just moving it from pocket A to pocket B. And if we needed it for long-term care, we're able to extract a ton of value from it. If we didn't, the residual value is still there for our heirs. But again, if we don't have the $150,000, we don't need to squeeze it out. It's not going to make sense to use in this situation.
yeah. Yeah, and I
Now,
guess the thing I would say, folks, again, we're reallocating assets from the conservative buckets for those who have it. And I know it's a lot of numbers, and frankly, Nick, I looked at the 6934 and had to multiply to make sure I got to 83,208. I wouldn't suggest getting lost in the numbers, folks, because these are all hypothetical, they're illustrations. But what I would suggest, exactly as Nick said, is having a plan. And the plan may not involve insurance, but I would rather there be a plan in place so if something happens, at least we know conceptually what should happen. And that's the important part. And then when you sit down with somebody and do the planning, then yes, the numbers can be uh, calculated specific to your situation. But I hope you can see what the benefit is. The worst part, I would think, Nick, is just not having a plan and, as we say, hoping. That's really not a good plan.
yeah, hoping when we don't have a plan, we end up spending our assets inefficiently. Maybe we would
Yeah.
have been able to go a lot longer with better care had we planned around it. And it
Hmm.
also just preserves relationships with your family because
Yeah.
they are the carer of last resort who's ultimately going to provide that. They're not going to put you out on the streets, but the stress that adds to the situation can be
Yeah.
significant.
Yeah, I have seen folks in my 35 years in the industry, uh, the elderly person in the hospital bed and four children each shouting at each other in ever increasing voices that they knew what was best for mom.
Yeah,
Incredible.
and
And it's like we were relitigating childhood. It wasn't so much about mom's care, it was about you, brother number one, who stole my crayons. And these
and
were mature adults as I was watching this. I'm just like, oh my God.
so tough. And the one with the loudest voice usually lives the furthest away too, for some reason. It's a recurring theme, not a one-off.
Yes, yes, they know best.
And
Yeah.
they always want to do the most aggressive possible solutions that everyone who's been living the situation may not necessarily agree with. But
Oh boy.
neither here nor there. There's one other great avenue to potentially fund a long-term care insurance policy with, and
Okay.
that's an existing non-qualified annuity. So
Okay, so
that's
something outside of an IRA. All right.
outside of an IRA. This is
Okay.
this is we can use qualified annuities for this in some situations, but it's not ideal. And you'll understand why completely in a moment because primarily we want to fund these with non-qualified annuities. The reason being It's that second piece of legislation I mentioned before. It's the
Actually,
Pension
Nick,
Protection
before we
Act.
jump into this, just a question that came up in the
Yeah.
chat from Carolyn. Does the death benefit get paid only if the long-term care is not used? So what I think I'm hearing you say, Carolyn, is somebody goes on claim, they still have residual money, the person dies. Does that residual money get paid out? Is that correct?
Yes.
Yeah,
Ah,
here's what happens with the death benefit. Say it's a $100,000 death benefit. For
mm-hmm.
every dollar OneAmerica sends you on claim, we reduce that death benefit by that dollar.
Okay.
So there is a death benefit there until $100,000 is received in this example, and then there's nothing.
Okay. So, to point though, Caroline, what just made my hair stand on end there is that after 1 year of those average numbers you showed us on whatever page 4, Nick,
Mhm.
we could have blown through the death benefit. Caroline, did we address your question?
Yes, you did. Thank you.
Okay. Yeah.
Excellent. So the other avenue of funding are these non-qualified annuities, or you can even use life insurance policies if they have a lot of cash value.
Okay.
But these are assets that we don't need for income anymore. So it's like the old deferred annuity that's grown over years. And now maybe we have other places that we can take retirement income for. And this highly appreciated non-qualified annuity may be one of the last places we want to go because all those taxable gains are going to come out. And we want to try to minimize the amount of taxes that we're paying generally. So what America's done here, and this lends itself, I began saying, to that second piece of legislation that I mentioned earlier, the Pension Protection Act,
Hmm.
says that if you fund an annuity care policy or any Pension Protection Act qualified policy with a non-qualified annuity, whatever gains were in that annuity that would have otherwise been taxable can come
Hmm.
out tax-free to reimburse
Nice.
long-term care expenses.
Nice.
So when you have these old annuities with a ton of gain in it, that can be a great candidate because not only are we going to get the insurance leverage, but we're also going to get the tax-free nature of it, where any other way we would have been paying taxes to the government on it.
So you're basically transferring, it sounds like you're saying, a non-IRA annuity
Mhm.
into a fixed annuity that specifically works with long-term care. Would that be sort of a simplified way of saying it, transferring one to the other and
Yeah.
no taxes?
Yep.
Okay.
Yeah, we do a 1035, so the movement of the money itself has no tax implications. And then
Hmm.
if the money is used for long-term care up to the monthly max, which in this case is 4,600,
Hmm.
as long as they don't exceed that, it all comes out tax-free.
Hmm. That's a tough one there. I'm taking 77,000 and dividing by 12, I'm getting like $6,000 a month. It seems to suggest you might need a little bit more than the 154,000.
And that brings up a good point, Timothy, because most folks, they're not going to plan on, when insurance is part of their plan, they're not going to plan on insuring 100% of their prospective needs.
Ah.
Because to do that is kind of oppressive. If we look at what the current cost is and how much it's increasing every year,
Hmm.
that's tough to catch up to. Most folks, if
Okay.
they were covering 100%, they would consider themselves to be overinsured.
Okay.
It brings me back to what I was saying earlier, where we can't let perfection be the enemy of progress, where we're just trying to do everything we can to set ourselves up for the best possible retirement we can. And
Hmm.
it may not be perfect, but we're trying to do the best we can with a limited pool of resources. I'll put it that way.
Yeah. Next question for you, Nick, from Sarah. Does the annuity continue to grow after being transferred over to use to pay for long-term care coverage?
Yes,
And
it
again,
does.
this is
Now,
at OneAmerica, obviously. If you're shopping at XYZ insurance company, I don't know how they work.
precisely. Precisely. And I would always recommend you shopping around to all carriers when if insurance becomes a consideration. One America is not the solution for everyone, and we certainly don't want to be. Um, but
One size does not fit all. We know
as an
that,
ins
folks.
no insurance carrier wants to hold all the risk. We just want a chunk of it. But what was the question? I sidetracked
So
my.
growth, Nick. So when
Oh, yes.
taking that non-qualified annuity, transferring it into in this case, you're saying a fixed annuity with long-term
Mhm.
care benefits, where does that money go? Is it growing? Is it the S&P 500 or something? How do we try to generate growth? And because I said that word, folks, past performance is no guarantee of future results. Markets go up and down. I'm not guaranteeing anything. I can't. The only thing I can guarantee is Cal Bears will lose this Saturday to Louisville. Sorry, no college
No
football.
problem.
Keep going, Nick.
Okay, so yes, it's growing, but it's a little complicated. So
Okay, but we can leave it at it will grow. There is
it will
some
grow, but
aspect.
I feel remiss to not mention in
Oh,
this
okay.
situation
If
the
you can
way that
boil
this
it
was
down.
the way that this was designed is that of our $200,000 premium, 154,000 is going into the annuity and is growing. But
Okay.
45,000 is paying for this lifetime rider, and that has no cash value or growth associated with it.
Okay.
So in this case, it's growing, but you have to take a $45,000 hit first, and it's growing from there.
All
Now,
right. So there's a portion.
there's a portion, and this in this case, this is a fixed annuity, so this is going to grow by guaranteed amount you can see on a ledger over time.
Hmm.
But that's all to say it's growing, but not all of it is.
Okay.
I don't want
Okay.
to
No,
mislead you
that's
here.
fine. That's fair.
Now, here's another example where instead of lifetime, we're trying to create a more meaningful monthly benefit. Because lifetime is great if we have enough resources. It takes away some of the guesswork on when we should trigger the claim. But more important than having lifetime is having some kind of monthly benefit that's going to make a meaningful impact on our long-term care expenses. So this is showing us $200,000 creating $8,300 a month in
Hmm.
long-term care, but only for 8 years, which on average is going to be good for most folks. You just might be a little reticent to make that initial claim, but 8 years is usually enough. But point being, you can sacrifice some duration of the claim to pump up the monthly benefit and get it closer to what we expect our actual expenses to be. 8 years, $800,000. What are we showing here? This is another lifetime example. Oh, in this case, so this actually bodes a little better to the question that was asked earlier with,
Hmm.
what kind of growth do we see? So in this case, we're using a $145,000 lump sum, maybe a 1035 from an existing annuity, plus an ongoing annual premium of 4,600.
Okay.
So the 145 that we 1035'd over, that's always just going to grow unless we go on claim and we start spending it down.
Mhm.
The $4,600 annual premium we're paying for the rider, that has no cash value, no growth. That's just pure insurance. That's the fire insurance side of the policy.
Yes. So, folks, as we head into the final 6 minutes, definitely any questions. I've got one eye on the chat box, and if I'm talking, James, Junior Advisor James, will keep an eye on it as well. But really, it's just trying to predict what might happen in your family. I've gone through many different personal planning situations and shown a bunch of different calculators. One that I was showing to a client in Alameda said retire at 67, and your expected life expectancy after that would be 20 years. I remember that client telling me very clearly, no, we Sicilian women are dead at 79. So you really need to look at your individual circumstance. And then against that backdrop, how are you going to plan for what may happen? And again, it's a best guess. Certainly, I hope none of us need long term care. I hope we all live long, happy lives and maybe pass away in our sleep. But the reality is, we don't know. And so you have to have a plan in place. That way, when this event does happen, at least people know what to do. Definitely, Carol. I'm more than happy to send you a copy of the presentation. This is also being recorded. At least I hope it's being recorded. Oh gosh, darn it. Did I hit the record? Oh no, looks like I did hit the record button. Phew, I tell you.
Start again.
Ah, man, sometimes it's like maybe I need long-term care just to remember to hit the record button. Jeez. Anyway, yes, it is being recorded, and yeah, I'll send out the presentation. Um, yeah, Jody, you can reach out to me and we can have a conversation around that. Carolyn, if I might ask you just to send me an email, timothy@greenretirement.com. And same for anyone else on the call. I'm happy to send you the presentation. And then in terms of next steps, really, it is just having a good long think. These are not fun conversations. I don't think any of us want to think about parents and long-term care, but Nick lived it with his grandmother. I certainly lived it with mother-in-law. And then for our own situations, again, I'm 57. I work out every day, but who knows where I'll be in 20 years? Um, so thinking about your personal situation, it's a little bit more of a challenge. But again, Timothy@greenretirement.com. Please send me an email. I'll be more than happy to send the presentation. I will be uploading this to YouTube, and then from there it will go on up onto my website. There will be a new section called First Friday 401k, and that's where that will live. Anything else, folks? Nick, any closing thoughts that you have based on your years in long-term care?
I would I would just add that there's generally two groups of folks that we see interested in talking about long-term care. And it's the
Mm,
first group are the ones that have lived it with family members.
yeah.
You know, they've experienced it with their mom, their grandma, someone in their family that they've had to help. And those are the folks that we can still work with. We have time to pivot and plan. But the other group of folks that are interested in talking about long-term care planning are those that are already starting to experience the physical symptoms of not being able to fully take care of themselves. So I just strongly encourage you to talk about some kind of long-term care plan before you end up in the second group, and don't necessarily wait for something to prompt you in the first group to get there. You know, talk about it while you still have options.
Well, again, folks, appreciate your time. My tentative plan for December is going to be a tax conversation, and then a January conversation will be had around ESG investing and what is the new world of ESG investing. Anyway, that's the tentative plan, and forwards we go. See everybody in December and into holiday season. You take care now, everyone. Be well.